quickly go on to the Stuart McPhee. And Stuart has the honor of being the last speaker today. So, well, aside from the QA session, I will stick around for as long as it's kind of practical for me to do so and answer any questions you've got related to MetaStock and the software. Show you how, for those of you that are new to MetaStock, I'll show you how everything, like scans work, and kind of give you an idea of how easy it is to kind of take some of the market expertise and kind of plug it into the software. But let's go ahead and talk a little bit about Stuart McPhee. You guys are going to enjoy this presentation, primarily because it's in an Australian accent. But in addition to that, Stuart's been a long-time partner of MetaStock. He's probably personally responsible for selling most of Australia, I would say, in terms of getting people over to our software. And he's a great trader in his own right. And did trading in a nutshell, a trading coach, does a lot of speaking events over in Australia. So with that being said, Stuart, let's go ahead and get you on here. I know he's here. I can see you, Stuart. Okay.
Just need to have my screen.
Okay, here it comes. Should be getting an option to join in any second.
Okay, hopefully that's all working.
I can see it. How to implement a trading process.
Jeff, thank you very much for that kind introduction. I'll do my very best with the Australian accent to keep that going, so thank you. For those listening in Australia or surrounds, a very good morning to you on Sunday morning. For everyone else, a very good evening or a very good afternoon. Thank you so much for the opportunity to speak with you today, and cheers, mate, and thank you for some of the comments coming through. But a very, very big thank you to MetaStock for the opportunity to participate and speak to so many people. Thank you for organising and giving me the opportunity to speak with you this morning. So I'll do my best to keep up the accent and keep that going for you. Look, you are more than welcome to at any time send me questions during the session. I'll do my very best to keep an eye on those. I've been keeping a track of those in the previous session, and they've been coming through very thick and fast. So I'll do my best to keep on top of those. I'm sure Jeff will remind me if I miss a few. That's just a very quick picture so you can visualize what I look like to match up the voice. Very quickly today, I obviously don't have a huge amount of time in my session today. I wanted to just open up with my beliefs of trading, my philosophy. I think it just provides some background information to my session and where I'm coming from and why I present the trading process the way I do. So I think that's important. In the limited time I have, I'm just going to spend a matter of 10 minutes or so just talking about my philosophy. I was very interested to listen into the previous session to a number of the questions and the way that was approached and the like. So I'll do my best to do the same as well. Look, just to start off with my philosophy, I'm not going to teach you anything new here. I might just provide a different perspective on things. All of these things that I'm talking about today are available in the ebook that I specifically prepared for this particular event. So I know that all registrants will receive a copy, including, of course, yourselves listening in today. I'm not telling you anything new here. It's absolutely critical, imperative that you develop a trading plan that's right for you, that resonates with you, that suits your personality, and then you implement or execute that plan with the right mindset, with great discipline and great decisiveness. It's probably here that I might just move off the track, and I'll just talk about my view on a trading plan, which might be a little bit different to a lot of people. We come into trading with a very, I guess our attitude and our outlook when we are first introduced to trading is very much a very, very positive outlook. It's excitement, it's a bit of adrenaline, it's a really positive vibe that we have. We maybe are sold on the idea of making lots of money and not going to work and and these things, and it's a very positive atmosphere that we find ourselves in. So we first learn about having a trading plan, and intuitively you believe that trading plan is designed to get you into the market. It's designed to identify trading opportunities and allow you to execute those, high probability, high quality signals. I actually think the opposite. I think your trading plan is designed to keep you out of the market, not get you in, keep you out. And if you trade stocks, or as an example, if you trade indices or currencies, for the majority of the time, your trading plan is just constantly saying no. No to trading opportunities. If an X stock comes up, it's no, I'm not trading that, nor that, nor that, nor that. And it's just constantly saying no. Your trading plan is constantly telling you not to trade. Every now and again, a trading opportunity will present itself because it meets your criterion, and it makes its way through, and then you assess it further and perhaps execute that trade. For the majority of the time, your trading plan is telling you when not to trade. It's telling you not to, and to not waste your time and move on. So automatically, your trading plan should have a very defensive, conservative purpose. It shouldn't be all, optimistic and exciting and wanting to trade everything that we can. It should be doing the opposite and being very restrictive and a very protective posture. We all know that the primary purpose or aim of trading is to actually protect your money. It's not to make lots of money, it's to protect your trading capital, because it's the very thing that allows you to in fact make some cash from trading. To take that a step further, I've done a lot of coaching over my journey, and I don't know if I'm surprised, but it's disappointing at times when I see the number of people who are completely overwhelmed with the prospect of putting together a trading plan, completely daunted and overwhelmed. And I can relate to that because I was too, right? So I can understand that. And that's unfortunate in a way. So we understand from that slide previously, we all accept that we do need a trading plan, but a lot of people don't go to that effort of putting one really good, solid, robust plan together. So what I simply try to do is to break it down into very simple pieces. So again, what I'm telling you here shouldn't be anything new, but it's just a matter of formalizing how do we put this plan together, what does it need to have. So again, nothing new here. It should answer, at a minimum, it should respond to 3 questions. How do we get into trading opportunities? Under what conditions? Whether they be technical or fundamental or a combination of both. I am pure and simple a technical analyst. I should say that from the outset. Under what conditions will you enter a trade? How much, how many, how much, how big, what are we risking, how many units, lots, contracts, whatever it might be, how much are we risking, and then of course under what circumstances do we exit that trade, whether it be at a loss or a profit. Very straightforward, but at a bare minimum, our trading plan should respond to those 3 questions. Interestingly enough, if we rearrange them in importance, they're actually the opposite. And again, I shouldn't be telling you anything new here, but again, it's just always good to be reminded of the fact that, and I heard an interesting comment in the previous presentation about exits and people asking about exits. I think exits are absolutely critical. And that previous presenter may totally agree with me. It's just, he just explained it probably a little bit differently, but to what I would. But exiting to me is just unbelievably important. And it's exiting that will determine, or largely determine 99% of the way there, on whether you actually do end up successful with this or not. So, and then question number 2 and question number 3 to finish off. Again, nothing new. I just want to finish off this introduction with my philosophy and my beliefs, and then I'd like to get into the process, which is why I'm brought here to talk about, which leads me to my first belief. And my first belief is trading is very much a process. It is a rules-based activity. Rules are there to protect ourselves from doing very silly things. You are the weakest link. You may in fact put a trading plan together, but if it doesn't resonate with you and suit you, then it's all the more difficult for you to be able to implement that and execute that correctly. When you put a plan together, the plan is just a compilation of trading rules, and your trading rules, under what circumstances will you do this? How will you get out? How will you size that trade, etc., etc. To me, trading is very much a process. It lends itself, when it is a process and a very system-based approach and a very methodical approach, it lends itself to the second point there, and that is that trading done very, very well is done very consistently. And consistency is a word that I use very, very often when I talk to fellow traders about trading well, and that is developing an edge and applying that edge ruthlessly all the time. Casinos do it very, very well, and casinos make lots and lots of money, and we can learn a lot from them by having a set of rules that provide us an edge and applying that with unbelievable consistency. That is what helps us try to have some measure of and some levels of success. I have been accused previously of being very anti-broker, and my next point is very much that. I think it's intuitive to think that the more you trade, the more you give yourself opportunity to make money. Right, so the more trades you place on, basically throwing lots of darts at a board, some of them are going to stick. I actually don't agree with that. I think trading less, is much better for your trading health and for your chances of actually making money. Trading less, to me, is more. I don't think that's obvious to people. I think when you trade less, you demand higher quality signals and just higher probability, higher quality signals. It's counterintuitive to think that trading less will actually end up having you, and it's got nothing to do with commission. I mean, that is obviously some part of it, but that's not the major part. It's just to do with demanding higher quality and this intuition we have, or instinct we have, to trade lots. And I think when we come into trading, we think about what is trading, and we think about activity, and we think about excitement. Well, that automatically lends itself to trading often and looking at a screen all the time. I don't believe full-time trading necessarily means looking at a screen for 6, 8, 10 hours a day. I don't believe that at all. I mean, you can do that, no doubt. If that's what you wish to spend your day doing, then of course you can do that. But trading full-time doesn't have to be looking at a screen for 8 hours a day. You can trade less, and I think trading less is just better for your trading health, basically. Need to move on with these. I also believe your best trades take time. It probably sounds obvious when I sound it out like that, but it's not obvious to people who are in a current profitable trade, and they can be so itchy and nervous about what's going on with that trade, and they think about closing it early and taking the profit and not letting profits run, or not letting the trade run its course and not let it reach its target, or whatever exit arrangements you have in place. It can be very easy to take that trade, excuse me, take that trade early and close that trade. Your best trades take time. Every now and again, and it's not guaranteed, but every now and again you may have a trade that instantly surges in to your advantage and to your favour. Every now and again it might happen like that. Excuse me. But the majority of time, your best trades take time to develop. What am I getting at here? Having a very, very simple yet robust exit strategy to ensure that you are in every headspace, be able to manage that trade and allow it every opportunity to continue to run. But the other thing, of course, is patience, an often understated, important character attribute when it comes to trading well. Patience not only in the beginning, but seeing out your very, very best trades and allowing trades to run their course. So excuse me, so best trades take time, so you need to have a simple strategy in place to allow that to take place and what have you. Anyway, moving on. I talk about this a little bit later on soon, about don't use things in isolation, so perhaps I'll revisit that, and please remind me if I don't. I cannot overstate the importance of simplicity and keeping it simple, and I don't have the time, but I could just talk the next 30 minutes on simplicity. It's human nature, it's human tendency to complicate anything in life. A saying I remember is, it's simple to be hard, but hard to be simple. It's very easy for us as human beings to complicate things, but it's actually very difficult for us to simplify things. And in trading, we always overcomplicate. It's natural. And yet I believe simplicity works in trading. Jeff mentioned in my introduction, I have my book, Trading in a Nutshell, now in its 4th edition. Whenever I sign a copy of that book, I always write those 3 words before my name. Keep it simple. Just be constantly reminded for simplicity. It's one of my tenets. It's one of my principles. And when I'm faced with a decision, I think about simplicity. It's something that I base a decision on. And finally, having data-driven decisions. Businesses know all about systems, and they know all about data-driven decisions. You know, companies and businesses have what they call BI, business intelligence sections, maybe one person, maybe a whole section, and they are constantly collating data about that business and its operations and everything. And then they present them in nice, you know, pie charts and the like, but they then very much base decisions on that data. And what I like to do for the first time today is just flick across to MetaStock, just to give you a very, very simple example. And hopefully that screen comes through very, very shortly for you. Just waiting for that. Hopefully, just waiting for it. It's certainly up on my screen here. Oh, I hope it comes through. Oh, yes, there it is. Finally, thank you for the feedback, for those telling me yes, yelling at me. Yes, I can see it. I can see it. Here's just a very simple example. This is nothing groundbreaking here, but excuse me. Here's the very simple example to let you know this is the S&P ASX 200 index. This is Australia's index, but we could of course apply what I'm talking about here to any global index. I've got 2 very simple indicators on this chart. They're mine, they're not groundbreaking. They are in my add-on, but they're not that groundbreaking, that's for sure. The bottom one down here is simply a sentiment indicator, so it's just tracking the sentiment of, it's just an oscillator moving between 0 and 100. I have these reference levels at 50 and 60, but the bottom line is where that red line is actually provides me guidance on something, and it's something to do with my risk management and my percentage of long versus short and a few other things. So that takes emotion out. It takes that you know, sort of spur of the moment or sort of jumping at a conclusion, that takes that out, and it just relies on a very clinical approach to decision making. And believe me, trading is decision making. That's all you do. Yes, you do some analysis, but you need to make decisions. Trading is decision making, and this can help me. This is a data-driven decision wherever this red line is. Another one at the top. Very interestingly, this is my, well, what's happened of recent. This is my volatility percentage indicator. So this is tracking the volatility of the index. And I have a black line there, a reference level at 1.5. For the first time, just a couple of months ago, and I think most global indices did this, for the first time in 4 years, the volatility broke through that threshold. Well, that actually then also provided me another set of rules that I had to use based on that piece of data. That is data-driven decisions. That's having rules that drive what you are doing. You become a better trader, I believe. I believe you become a far better trader when you remove you and remove emotion and remove sort of what you are believing about the markets and what you hear about on TV or reading somewhere, to just simply very clinical, methodical approach to making decisions and having very data-driven decisions. I've got one more example here because it's certainly very much a part of my add-on, and that is just a very simple stock that I may have an interest in right now, and it's an Australian stock. You might even recognise what it does. It's called Sydney Airport. I know it'll just take a second or two to come across on your screen, but this is another example of a data-driven decision. And again, hopefully it comes across on your screen shortly, but that red line there is my trailing exit for long trades in stocks. It's just a simple red line, and yet it is such a critical decision that I make, but it's very data driven. And all I need to look at is, you know, has price closed above or below that line for a long trade? And I've got 3 girls, and my youngest daughter could tell me whether it's, you know, moved, you know, is above or below. That's how simple it's made for me because I have data driving decisions. And it's a very important decision. And you can see the commentary over here, you know, provides information on position sizing. So it's all data driven. I don't have to think about, oh, this is a really good opportunity. I like what this company does. I think I'll put a little bit more money into this trade. Or I'm not so sure about this. Maybe I won't put. No, 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 no. Don't do any of that. That's not good trading. It's obvious to do that because we think we have a very important role to play. But I think the less of a role that we have is probably better for us. Anyway, enough on that. My time is escaping me, unfortunately. And I think, excuse me, and I think, you know, we're singing the plaudits of MetaStock. I've used MetaStock since 1999. I can't believe it's been that long. But one of the things that really attracted me to it was the very mechanical nature of it. Now, I'm not a mechanical trader by any stretch, but I do have the software doing most of the work for me. I don't want to look through, I don't want to have a look through, you know, 500 stocks and look through 500 charts. I want MetaStock to go away and do some number crunching for me and then come back and present 8 to me or 3 or 5 or in some, you know, in some cases 0. That's what I want. I don't want to look through 500 because that's daunting in itself. So my data-driven decisions and then going back up to aim for consistency, I'll tell you what, that's where MetaStock just wins me hands down. That's where that's really the greatest advantage or tremendous advantage that in fact MetaStock provides to me in that sense. Thank you for the flow of comments that are coming through. I appreciate that. There hasn't been a whole lot of questions at the moment, but that's perfectly fine. So I'll get on to, excuse me, oh, there's a little bit more specific question. I'll get to that in just a second because I want to start working through my 7-step trading process. And then I'm going to go through and break down each of these steps for the remainder of my time and just spend a little bit of time on each of these. And again, I just need to wait for all that to flow through to everybody's screen. I am overwhelmed with the number of attendees currently in this webinar session. Unbelievable. So well done to MetaStock for getting all these people here. That's outstanding. So hopefully it's coming through to the screen now. Look, very, very straightforward. And as you read through that list yourself, you're going to go, yep, that makes sense. I got that. I understand that there are no surprises there. However, when we are struggling to put a plan together and to have a routine that supports that plan, this to me is gold. And I don't want to oversell it, but it's a very simple, logical, step-by-step process for traders to work their way through. And for those struggling to put those pieces together, this can provide a framework. This can provide some structure. Because when we don't know any different, and it's not obvious to us, you know, what is trading? We just open up MetaStock and we perhaps open up the first stock listed on the exchange, and it might be AA or AAB or something like that, and we go to that and we say, do I see a trading opportunity here? And we just look at it and look at it. Keep looking. Maybe we zoom in a little bit. Maybe we zoom out. Just sort of tilt our head a little bit to the left to try to get a different angle on something. We don't know what we are looking for. We're just hoping that something literally just pops out at us and provides us an opportunity, you know, to trade. But of course, that's not really the reality of trading. We should be able to look at a chart and know very, very quickly whether it's a trading opportunity or not. Another issue that I see commonly is, you know, I've spoken to a lot of people, again, over my journey, both through this forum here, but also live in person. And, you know, there are a lot of people who have done extensive work on technical analysis, you know, and kudos to everyone here today who has spent a number of hours listening in on hopefully some very high quality instruction and just trying to develop a little bit more competence. So working our way along this journey to try to become, you know, really, really solid traders. So a lot of people have done a lot of work like yourself, and they've read books and they've attended seminars and conferences and the like. They just struggle to get that final piece of putting it together. And because they've learned about a particular technique or indicator in technical analysis, there's not an obligation, but they feel like they would be doing something wrong if they didn't include that somehow into their approach, into their system. And it's very difficult sometimes to have to eliminate things, basically remove things and say, well, I'm not going to use this. I can't use this. It sounds good, but I can't use it all. So that's a difficult process of effectively eliminating things and what have you. Anyway, this is the process. Let's work our way through these now, and I'm going to spend probably most time sort of in steps 2 and 3, and then also 4 and 5 so far as the, I hope you've scanned through, and I hope you've gone to step 7, because that to me is very, very important. Time may escape me today and I may not get to it, but I very much want to get across the fact that I think the worst thing you can do when your trades are on is watch them and try to interfere. I believe the best thing you can do is let trades run their course, and allow the rules and allow data to drive what you are doing, not you sitting there getting impatient and watching your trades. And I've certainly got a lot of experience myself in doing that in my early days. And yes, you can play with your horse if you wish to, as somebody has suggested, whatever you wish to do, but I really believe you need to go and do something else. All right, let's start with step 1. Step 1 is quite easy. It's probably maybe again not so obvious to people, but we now live in a world where trading platforms allow for automatic execution. Trading platforms allow us to, as we enter the trade, to place a stop loss in place, to have a take profit in place, to have a trailing exit in place. We can do all of that. This is exactly what I do when it comes to currency trading, because I'm not getting up at 2 o'clock in the morning to see how my trade's going. So, you know, trading platforms allow us to do this now, but I still think it's important, if we're doing this on a daily basis or every few hours, it's important just to, how is my trade going? Not to interfere with it, not to try to second guess and try to speed things along. It's just to make sure that everything is okay, that the exits are in exactly the right spot. The trading platform is doing its job and everything is going the way you should, you know, you want it to be going, not to interfere. So it's just a very simple, you know, first step. Where is my money at risk? The money sitting in the trading account is not at risk. It's effectively in a bank account, more or less. It's not at risk. It is not exposed, but any money in a current trade is absolutely exposed and is at risk. So let's just have a quick check of seeing how all that's unfolding and going, and maybe that might have a role to play so far as selecting further trades. And if particular ones are not doing so well and they're in a particular segment or market or something like that, then that may influence what we do in the next few steps so far as selecting further trades. So just a very quick review of how everything's going. More importantly, of course, is let's go ahead and now look for more trading opportunities. So I talk here about scanning or looking through your trading universe. And this is a phrase that I like to use, your trading universe. What is your trading universe? To me, your trading universe is that group of financial products that you will constantly or regularly look at for trading opportunities. Here is a problem, I believe, and it brings me back down to the point at the bottom of the screen there. Can you trade everything? There are so many trading platforms and brokers out there now, so many, and many of them will offer thousands and thousands and thousands, tens of thousands of different financial products. That can be a selling point. Hey, we cover these markets from here and over there, and we cover all these, you know, stock exchanges and futures, blah, blah, blah. We offer, you know, 15,000, 25,000 financial products, and you're going, wow, that's awesome. Here I am sitting on my phone at a cafe having a coffee. Here I am sitting on my tablet, on my laptop at home, and I can trade anything in the world. Wow, that's exciting. However, can you trade everything? Well, I don't think that's a really good idea. Just because a platform may make itself or make available tens of thousands of financial products, from cotton to gold to, you know, the S&P 500 to the euro dollar against the US dollar or the Japanese yen or whatever it might be, or individual stocks, that doesn't mean you should be trading them. You need to define what your universe is. So I've listed very broadly there financial products, and again, nothing new to you, but the way you trade commodities is going to be a little bit different to the way you trade, say, indices. Currencies move different to stocks. They do, I know from experience. Yes, a chart is still a chart, no doubt, And a moving average is still applied exactly the same way. And support and resistance is very similar in stocks and currencies. I think probably a little bit more valid in currencies, but you know, some of those rules and technical analysis concepts are very similar, no doubt. But the way currencies move is going to be different to stocks. So can you apply the same strategy to either? And when we are starting out, are we going to be good enough to understand the different sort of manipulations we need to make in our rules to trade different products? I don't think so. So just because you can trade everything effectively now in 2015 doesn't mean you necessarily should. I know quite a few people who trade one product. They will trade one index, that's it, and they'll just go long and short. I know people who will just trade one currency pair. They'll just trade the euro, right? The euro against the US dollar, that's it. And that's perfectly fine. I tell you one thing, they gain an incredible intimacy and great insight into the way that one product moves, that is for sure. I personally look between 8 and 10 currency pairs. When it comes to stocks, I look at 500. So your universe shouldn't be tens of thousands, I don't think. And the way commodities and indices and currencies move are all ever so slightly different. And that, I think, comes with the experience for us to identify and understand exactly the differences there are and how they are different. So your universe, obviously you need to define that. And obviously any testing, any validation you do, I would think needs to be based on that particular group of products that you are interested in trading. I think stocks are a very common starting ground. I think there are just a common level of understanding of what a stock is. We understand the equity in a business, in a company. We understand being a holder of equity and dividends, and we understand the very basic idea or concept of what a stock is and how it's equity in a company. So that often is a starting ground for people. Having said that, with technology and trading platforms as accessible as they are now, they're not always a starting point for a lot of people. And of course, when we move into the other products that I list on that screen there, we are now talking about leverage. We're talking about a leverage product and trading with margin, and that leverage may be anything up to 100 to 1 with currencies, or unfortunately in some jurisdictions that moves well beyond 100 to 400 and 800, even beyond, which I think is bordering on criminal, but that's the way it is. So of course, trading with leverage provides you tremendous advantage, but equally provides you unbelievable risk. And if we're in our early days and don't understand that, then obviously that poses tremendous problems so far as risk, and people just draining their accounts in no time, basically in the blink of an eye. Look, there have been quite a few comments come through, and I'm doing my very best to move my eyes back and forth, but one that is quite relevant to what I'm talking about now. My favourite markets to trade and why. Probably very similar to what I was just talking about. I started in stocks back in the mid-90s because it was obvious. It was, I mean, accessibility of other markets certainly wasn't the same as what it is today, but it was the obvious starting point because, you watch the news in the evening, and towards the end, just before sport came on, they talk about what the index did, and they talk about, the large companies and banks and their stock did this, and there was a familiarity with them, and you could recognise and you knew the names of those companies because you'd drive down the road and see a branch of one of those banks, or you'd see that grocery store or whatever it might be. So that was the obvious, and I've still trade stocks in my retirement fund. We call it a self-managed superannuation fund in Australia, or a 401k or something like that, which we are able to control ourselves. So I still trade stocks to this day. I'm either long stocks or I'm in cash. But my more active trading, and I use that term loosely because I don't look at a screen for 10 hours a day by any stretch. Since about 2008, I've been trading currencies quite actively and I was always scared of currencies because of the leverage. And then I was introduced in 2008 when stocks didn't have a great year. I was finally convinced to have a look at currencies, and I did that. And I just love the way currencies move. I love the fact that there are very few to trade. I'm not looking through thousands of stocks with other sort of influences on those stocks and management and trying to learn all that stuff. So currencies to me has certainly become my more favourite pastime, and looking at currencies. Yeah, I just love the way they move, and the fact is you can very much control leverage, and I'm not a very risk-taking person by any stretch. So I'm reasonably conservative, so I am able to control that leverage using the platform I use and turn that down a bit. Yeah, that's what I trade now, a little bit more actively. Someone asked about I don't know if that person is a plant, I hope not, but they asked about my systems and my platform, my add-on. I have two main systems or strategies within my MetaStock add-on. One I would never use with currencies. It's a lot more medium term, and it is ideally suited for stocks, and it's what I use for my retirement fund and my money. The other system I think you can use with almost anything. It's a little bit more shorter term, and I love using it with currencies, and certainly trading shorter term with stocks. So hopefully that helps you out. But just look, obviously it's an individual decision. I just want you to be mindful of the fact that because a trading platform presents you with 10,000 products doesn't mean they're all the same. That's all I wanted to basically get across. So it can be very appealing and exciting to have that accessibility, but I think we need to be a little bit more disciplined to almost say, you know what, I have no idea about cotton or the way sugar moves or the way, you know, Brent crude oil moves or anything like that. Maybe I shouldn't be doing this, or maybe I just need to do a little bit more homework or research or validate my strategy with that particular commodity before I get any further. Anyway, obviously a personal choice. Let's go ahead now and just talk a little bit more about process of looking for opportunities, and that is basically scanning our universe and looking for particular trading opportunities. Now, I've heard, or I've seen and also heard a lot of comments about time frame, and I think time frame is unbelievably critical in developing a trading strategy and having a plan, and this also presents a very difficult problem of what should my time frame be? What should my trading style be? Can I trade any time frame? You know, if you go to the MetaStock RT, you'll see the fact that you can select a number of different periodicities. You know, from very, very short time frame up to, you know, a day and a week, but that doesn't mean you should be looking through all of those for trading opportunities, because the way you trade each of those is very different. So let me just talk a little bit more about how we can select time frame, and this is an idea that I came up with a long time ago to provide people some guidance on how they develop their trading style and their time frame. So take this as just a general commentary on how you can do this. Again, I'm just waiting for that screen to come through to you. Hopefully it won't take too long. Yes, again, people are yelling at me saying, I can see it, I can see it. But, so hopefully it's all come through here. And I do appreciate that feedback, of course. What I want you to do is just on the right-hand side of this table, have a look at the average trade duration there. Now, all of us, I believe, whether we are trading or not, have a visualization of what or how we see ourselves trading. In other words, detach yourself and go away and stand at the doorway of your office, look in on you in a month's time and have a look at what you are doing, and have a look at your trading screen and your platform and your MetaStock, and what are you doing? What are you trading and how are you trading it? We all have this sort of visualization of our perfect setup and our perfect trading strategy. And what we're able to do with that visualization, and in the back of our mind an idea of what we want to do, is come back to this table and slot yourself into one of those categories of how long your typical average profitable trade, its duration, how long it goes for. Is it within minutes to hours, hours to days, days to weeks, weeks to months? Which category could you slot yourself into? And I believe 99% of people should be able to put yourself into one of those. And when you have put yourself into one, and remember, there is no right or wrong answer. No right or wrong. It's what is right for you. Remember, trading plan suits your personality. Once you've slotted yourself into one of those, you can come back across to the left, and I have assigned yourself a trading style, whether it's VVST, very, very short term, VST, very short term, or medium term. Just assign yourself a category. And when you have assigned yourself a category, then perhaps we can assign a suitable and appropriate periodicity or chart periodicity to trade that particular trading style. This all of a sudden provides us a little bit more focus on time frame and trading style and where we fit within the spectrum of trading styles. So if you're going to trade short-term or medium-term, a daily chart I think is the best starting point. I mean, it's just a great way to look for trading opportunities. You know, do I need to look at a 5-minute chart? Not if you're trading off daily charts. If you're trading off daily charts, you're looking at a much bigger picture and you really are not concerned with what's happening in the next 5 minutes. So that's where focus is important. And whatever you do, down the bottom I've got my keyword again of consistency. Consistency is a key. And once we've identified a time frame, a trading style, a periodicity you use, that's what you use. And the fact that the trading platform presents another 14 different periodicities doesn't mean you use them all. Doesn't mean you run the menu looking for trading opportunities. Okay, and I just don't think that's a very good thing to do. So, excuse me. So, you know, provide yourself a little bit of focus. This is my point before about not using things in isolation. I don't believe trading opportunities are best found by just using one single signal, right? One individual technical analysis condition. I mean, you can trade that way, don't get me wrong. You can plot 2 moving averages on a chart and every time they intersect, sure enough, that provides you a signal. But I think we can do it better than that. I think we can improve upon that. So I believe very much in combining different components to develop the best strategy and the highest probability and high quality. So for example, I call my currency strategy TLS. I look at trend, I look at levels, and I look at signals to provide me an opportunity to trade into that particular trend that I've identified. So we can look at trend all the time, and I'm very much a trend following, absolutely. Trend following, I think it's the least difficult way to make money trading. You know, do we look at different candlesticks or chart patterns to enable us to identify entry points into those trends? Do we look at key levels, support and resistance, and how will they affect your decision to enter or identify trading opportunities? When you have a mountain load of resistance, literally pips or points above where you're about to go long, does that provide a stop? Does that stop you? It should, you know. And so how do we include that into our trading process and our strategy? Do we use technical indicators? And there are 50 million of them. So do we do that? Do we include them somehow in our trading process? And I also believe in not picking the first trade. So the scanning your universe may present 5 opportunities. It may present 0, it may present 25. Just because you've come across the first one doesn't mean, whew, I'm done with that step, I can now move on and trade. It may be the worst of the opportunities you find. So don't just take the first trade. I also believe, depending on your strategy, you will routinely be presented 0 trading opportunities. 0, that's it. That means you're done for the day. There are no trading opportunities today. And I don't think that's a bad thing. That's your trading plan fulfilling its purpose. Your trading plan is telling you nothing. There is no opportunity today, and that's probably for the right reasons. So don't pick the first one. Scan your universe, look for opportunities, put them all down, and then we begin the process. And I explore this a little bit more in the ebook that you'll all be getting. You know, how do we go about selecting, you know, what's the best opportunity of those, and what risk management rules do we have to dictate or determine how many of those opportunities do we take? Do we take all 5? Are we only permitted to take 2? What are the risk management rules that tell us that? That's all in our plan, because we want to make data-driven decisions, right? That's what good traders do. So don't necessarily pick the first trade. Go through the universe. Just because a stock begins with the letter X doesn't mean it should never be traded because it just so happens to be at the end of the list. Don't pick the first, go through them and then review, and have different criterion to assess and rearrange, not in alphabetical order, but rearrange based on important criterion for you to be able to select you know, the best trading opportunity out of all of those. A few more questions coming in, which is just terrific, and I really appreciate your contributions and your playing a role in this session. Someone has asked about, do I do this pre-market in the first 30 minutes? It is very much dependent on your trading style, and one thing that I haven't covered yet, and I was going to cover at the end, and that is the frequency in which you move through this process. Once a day. So that's your periodicity, your trading style dictating the frequency, right? How often you would run through this particular trading process. So when you do that, you know, it's very much up to you. I think if you're trading on daily charts, really once that market has closed and all those candlesticks and price is now locked in history forever and won't change for that particular day, you're then able to open up MetaStock, open up the Explorer, run your exploration, run your systems, and find out trading opportunities, rearrange them in the Explorer results, and excuse me, and rearrange them, and then work your way through and begin that process of looking for opportunities. So frequency, I think, is an important thing. When you do that, it's probably very much up to you, and whether you want to wait for the market to open, of course, is completely up to you. I've just got a few quotes here. I love my quotes, time-tested quotes, and here is one from one of the traders interviewed in one of the Squillion Market Wizards books that are now out there by Jack Schwager. He says, and I know the screen is still coming through for a few of you, but I'll read it anyway. He says, you need to determine why the winners and why the losers are losers. Once you can figure that out, you can become more selective, and that's the key for me. You can become more selective in your trading and avoid those trades that are more likely to be losers or losing trades. You can become more selective. The more we go about looking at charts and understanding technical analysis, I believe that the clearer charts become, and the more we develop our own beliefs about what works and what doesn't work, and that's wonderful because that's what we need to input into this journey of developing a strategy right for us. You become more selective. The more you trade, the more you look at charts, the far better, I believe, you become at looking at two trading opportunities and being able to say, that looks much better. That just, I mean, look at that, it's got no there, that resistance is there, or except you just become a lot better at it. You become more selective. Really good thing. Someone's asked about position sizing. I'm going to get to that very, very shortly. Hopefully Jeff does not cut me off. I'll do my best to get to that. Again, the Turtle Traders, William Eckhart, who said the desire to maximize the number of winning trades or minimize the number of losing works against the trader. The success rate of trades is the least important performance statistic, the strike rate. But we focus a lot on strike rate, and if I was to say to you my currency trading currently is running around 42% strike rate, you might think I'm a rookie. You might think that's very amateurish. That's just not very good. But 42% is perfectly fine when the reward to risk and the exits and the average loss and average profit and the like is all in my, in my favour. So, excuse me. So, as someone said, you've got to know when to hold them and know when to fold them, right? Just a great song and a great saying. So, strike rate's not that important. And then finally, I don't think you can consistently be a winning trader if you are banking and relying on being right more than 50% of the time. And my philosophy or belief on this is achieving a strike rate of more than 50%. That's not profit, that's not return, that's percentage of winning trades. More than 50% is actually quite difficult to achieve. 60% strike rate consistently, I think, is outstanding, is really, really good. And it's not obvious to people. You think the higher that strike rate, the better the results and what have you. And of course, that's not guaranteed, as some of you are feeding through with your comments. So, excuse me. So, and then finally, sorry, Ed Sekoda, another trader. I love my quotes, so I'm just going to feed a few of these in. And I particularly like this. I know it's quite long, but he's basically talking about components. So 1, long-term trend, 2, current chart pattern, and 3, picking a good spot to buy or sell. So all I'm trying to help people with, and just in response to a question, a comment I've seen earlier, all I'm trying to do today is to help people put the pieces together. I think you have today probably heard enough about strategies and been provided different ideas And yes, my add-on has, a few strategies in there, and you're welcome to test those and validate for yourself and what have you. But I'm trying to help people in the more boring things of putting the pieces together and providing some structure and framework to the process that is trading. And I think that is quite lacking at times because, again, what I say a fair bit in my ebook that you'll receive a copy of is that too many people for me trade randomly. They trade indiscriminately. Right? They just trade randomly. And that's a horrible way to trade. They just randomly look for trading opportunities. And trading done well is done very differently to that, but it's not obvious. Like so many things in life, the path to success is not obvious, and that's certainly the case with trading. So yes, exactly what you're saying there about percentages. And in school, in school we're talked about 60 being a pass or an 80% being a pass mark, and we bring that into the markets and trading, and we're really striving for something that's quite unrealistic. Very, very unrealistic. Okay, let's talk a little bit more about risk, and I appreciate the fact that people have been asking a few questions about this and about risk and the like. I will talk about position sizing. You may have noticed in the MetaStock software here, my ignition system doesn't do it, but my altitude trading system does do it. I have just a very simple, actually it's not that simple, it's quite complex in the coding, in doing all the background work for you, but in the commentary of my expert advisor for the altitude trading system, there is the methodology I'm about to talk about, excuse me, does actually all the calculations for you, and you can read a few things there that it's talked about. So that to me is very helpful. It makes it very mechanical and data driven, and it removes that emotion of, oh, this is a really good stock, I like this, I'm really going to pour a lot of money into it. Again, that's not good trading, and that's not managing risk very, very well. But let me just come back to determining stop. I just wanted to provide a quick overview of managing risk as my time of course quickly gets to run out. Again, a little bit more of my beliefs here. From a practical decision-making standpoint, the decisions you make relating to risk management are everything, right? Are critical. So yes, and I bore people to tears talking about psychology and the mindset and different character attributes of good traders. All the things we know we need to hear but probably don't enjoy listening to because we are reminded of all the mistakes we've made. But yes, psychology is important, and the 6 inches in between your ears are absolutely everything when it comes to trading. But from a decision-making standpoint, the decisions we make to manage risk and position size and how many units or how many lots or contracts or stocks we're going to trade and how we get out of that trade, whether it be at a loss or at a profit, are everything when it comes to trading. I believe a very poor random entry can be saved by just a very good simple exit. But you cannot say the same, because a really, really good entry for all the right reasons, high probability, high quality entry can be completely screwed up by a horrible exit. I know because I've done it too many times. So, the exiting is the key component, right? The really, really good entry can be completely screwed up by the exit. A very poor, horrible entry can be saved by a good exit. I talk about 8-2 and 2-8, which just reminds us of that strike rate. Out of 10 trades, you can have 8 profitable, 2 losing, yet still lose lots of money. You can have only 2 winning and 8 losing, yet still make lots of money. It's all about the average loss versus the average profit. Things like expectancy. Dr. Van Thart wrote about this years ago in his Trade Your Way to Financial Freedom, and he talked about a snowman and throwing blocks of snow at a snowman and what happens to that. Just all these sort of, this is when trading becomes a little bit more mathematical and a little bit more systems-based, but that's good for us because I said before, I believe trading done well is data-driven. We are talking about data. We're talking about a very mathematical approach. We're talking about how we measure reward versus risk and trying to achieve a certain ratio, 2 to 1 or 3 to 1 and what have you. So when it comes to exits, again, I'm not trying to teach you anything here you don't know really, but just to remind you that, initial stop losses are critical. I'm sure everyone now and again, someone will come along and say, oh, don't worry about stop losses early on, just wait for this to happen or wait for this. And of course, they're entitled to their opinion. I just don't like the idea of placing a trade on, even with all the intentions of watching it for the first 5 or 10 minutes and not having a stop loss on. anything can happen in that 5 or 10 minutes, and I'm called away and the phone rings and something happens and I'm dragged away and all of a sudden my account is drained from just one simple mistake. Not likely to happen, but it remains a possibility, and if I can control that, I would like to do that. A lot of different ways of measuring and setting that stop, whether it be a technical level or measuring volatility and using one of my very favorite indicators, and of course it's in MetaStock, the average true range, or just using percentages. It's really key to your survival, and that's really the way we need to approach our trading, and that is to survive a trade. And the longer you survive, the better chance, I think, of eventually making money. I love this quote, and someone just said before about enjoying the quotes, so I appreciate that. I love them. I think it's a constant reminder of what we need to do well and what remains time-tested and will always remain true, and I love this one. If you can follow these 3 rules, you may have a chance. So Ed Secoda says there's only 3 things you need to do, and that just really, again, focuses us back on what's really important when it comes to trading, and I love that. Only 3 things, and if you can follow those 3 things, you may have a chance. I love this approach. Don't focus on making money, focus on protecting what you have. Again, this is a 180-degree turnaround from why we come into trading. Correct me if I'm wrong, but I think the majority of people's primary motivation to trade rhymes with honey and begins with the letter M for Mike. Right? It's money. It's our primary motivation. And here we are saying, oh, don't focus so much on that. Focus on actually protecting that cash. That means trading less, managing risk, having smaller trade sizes, cutting losing trades. It's all those good things that good traders do. And I love this saying as well from Marty Schwartz. The most important thing in making money has nothing to do with your profitable trades. Nothing to do with your profitable trades. It's not letting your losing trades get out of hand. And I think that's a terrific quote. Learn to take losses. The most important thing in making money is not letting your losses get out of hand. And hopefully that comes through for some of you. I want to talk a little bit more about the exiting as well, because it's all very well and good to focus on losing trades and stop losses, but how about when every now and again, for some reason, you have a trade that moves in your favor, which is terrific, right? So we're now in an unrealized profit situation. What do we do? Well, there are 2 main schools of thought here. We either use trailing exits, so they move behind the price and move in the same direction of that price and trail either behind or above if you're trading short, and by a particular distance, and they lock in profit as price moves in your direction. So this, of course, supports the concept of letting your profits run. The example I had there on MetaStock previously, that red line, again, I'll just wait for that to come through. Just keep talking, I guess it'll come through eventually for you. So that red line there is a typical trailing exit. I base that on average true range, which I think is a tremendous, very simple indicator. I've been using this now for a long time, and it's very much a part of the trading system, the altitude trading system. I think it's a very, very, and again, this thing I think is gold. It's just a red line on a chart, but the number of times I've used it and the number of times it has done very well for me and saved me at times, I see its value as far greater than just a red line on a chart. So, and that comes obviously from just familiarity and experience in using it. So that's a very simple example. That's visually, if you take that's a good textbook example. That's visually what a trailing exit should look like. There's a number of different ways in which we can do that, but of course the other different type of, and I'll talk about which one we select in just a second, the other type is to actually not have a trailing exit but a more defined stop point as a profit. So we call them profit targets or take profit levels. So these are a predefined distance away from our entry, a very simple way to identify that, certainly to consider support and resistance. Cool terms is just simply to consider how far away is my stop loss point, and then trying to achieve a multiple of that stop loss distance so far as a profit is concerned. So what we don't want to do is, consistently risk 50 pips or 50 points and then set a target at 30. Because then you need a very, very high strike rate. It just comes down to mathematics. A very high strike rate to be able to actually make $1. So we need to have that reward to risk relationship in our favour. And again, this is where trading, as I said, comes back to very much a numbers, data-driven, mathematical-based thing. But trading done well does often come down to this, and considering units of risk, or the letter R for Romeo, and so how we set that. So my commentary on which is better. All throughout my stock trading, I have always used and continue to use trailing exits, which is what that red line I just showed you before. My ignition system also uses a trailing exit, but a far more aggressive, and it's a lot tighter, a lot closer to the price because of the shorter term nature of trading the strategy. But certainly trailing exits. When it came to currencies, and starting with currencies, I have always used trailing, so I bought trailing into trading currencies. And very quickly I found out it wasn't working anywhere near as well as it did with stocks. And then of course people started to talk to me about, well, everyone uses take profits or profit targets in currency trading. We define the unit of risk, 50 pips, and we set a target at 100 to achieve a 2-to-1. And I'm going, oh, okay, well I need to look at this a little bit further. So I started using profit targets all the time. And then I'm realizing that in some cases, a currency will just get on a run and just continue to move so strongly. And here I am sitting sort of almost with a smug grin on my face that I achieved a result of a profit of 100 pips. And sure enough now, 1 week later, it's now 320 pips. So I'm thinking, I can do this. This is all part of the process and the journey, isn't it? It's just that constantly evolving. And so then I started to get back in and reintroduce trailing exits, and now I had to work out a way in which, under what circumstances do I set a take profit level, and under what circumstances do I use a trailing exit, and can I use both in the same trade? So I've now been working on that for the last few years, and I've come across something, and just something I'm comfortable with. It's not rocket science, but it's something that resonates with me and I now use. So I now use both, and I don't think there's probably many currency traders that consider both. I would think majority consider profit or take profit levels or profit targets. So there's obviously a number of different options available to us when it comes to exiting, but of course exiting is just so ridiculously critical, isn't it? So, excuse me, so again we need to think about how we're going to do that, and that it's all part of the process. I'm all coming down now to, and as my time is very quickly escaping, all coming now down to, we've scanned our universe, identified time frame and looking for opportunities in that time frame. We've started to identify stops and how we set initial stop loss. And then finally, probably the important part, last important part on this 7-step process is, of course, position sizing. A very simple way, of course, is to take your capital and break it up into pieces. This obviously answers the question of sizing your position or sizing your trade, and that is how big your trade will be. How many units, contracts, lots, options, whatever it might be. And there's a very critical part of managing risk. I think, certain opportunities may have significantly greater volatility, and are we wise to place an equal sum of money into that trade exposed at risk as to the previous trade, which didn't have anywhere near as much volatility? So those sorts of things can be incorporated into how we, size our trade and how we position size. And I think I heard the previous presenter who was talking about, putting lots of money into one trade and not being a great idea, and I couldn't endorse those comments anymore. Just putting all our money in just because we feel deep down that this will be the one and this will be the great trade of the year is just foolish and asking for trouble. So it's a very simple formula. There it is at the bottom there. I've actually just brought that back up to the top of the first screen. I've got a simple example here. And perhaps if I've just got a few more minutes, I'll run through this example. So just waiting for that screen to come through. And I know a few of you are going to yell at me saying, I can see it. It's there. So the number of units or the size or what have you, I think is a very simple formula. It's simply the risk amount that you determine how much you are prepared to talk about 2% of your capital. That's good for stocks. It's probably not ideal for other products, but identifying a notional amount, I'm prepared to lose $100 or 50 or 500 or 1,000, and then we divide that by something called the DTS, which is not as complicated as it sounds. It's simply the distance to our stop. In other words, how far we're prepared to allow price to move before we do in fact get stopped out. And certainly if we're trading in any currencies, we need to include currency exposure into that as well. In stocks, that's not necessarily an issue, but in currencies it certainly is. So as a simple example, if I was prepared to risk $500 and my stop loss was 40 cents away, right, 0.4 of $1, I'd do the math and I'd be allowed to trade $12.50 at $6, just throwing in a $6 notional value, and therefore $7,500. The very simple concept being that if all those 500 stocks dropped 40 cents or 0.4 in value, if I was to, of all those 1,250 stocks all lost 0.4 in value or 40 cents, you would lose $500. So it's just a very simple yet very powerful way of managing how much you lose should you get stopped out. It's very easy to think, well, the further away I place my stop, the more money I'm going to lose. Yes, that's if you use an equal portion method and you're always assigning the same amount of money to a trade, but this sort of negates this. This says you place your stop loss in the best position, and then we'll do the formula to ensure that you only lose a set amount of money. Very simple formula, very powerful formula. This is in the commentary that I was showing you before as part of the expert advisor that I was showing you before. And finally, from a mechanical, decision-making standpoint, placing the trades on the platform, I'm going to spend no more than 1 minute on this. Different ways in which we can trade, whether we just go in or whether we set the price. Different brokers handle these executions or orders very differently. Not very differently, they handle them differently, and I cannot overstate the importance, and I make this point very clear in my ebook. I cannot overstate the importance of understanding exactly how your trading platform or how your broker handles particular orders, because I know I've seen examples of that costing people money. They thought they were getting out, but they only got out partially. So please totally understand the way your trading platform or broker handles particular executions. And then, of course, finally, do something more productive. And I don't want to talk about this point for too long. It's just the notion that, the more we look at trades, the more that we can think we are trading, and we can get in there and interfere if we need to and fix problems. But as I said, I think you are the weakest link, and I concede that this does take time, but I think it's a really good approach to trading where you place trades on a platform and you go and do something else, whether that's play with your horse or go out and play golf like I'm going to do this afternoon. Just go and do something else. Just let trades run their course, and trading platforms and technology has made this a lot easier for us to be able to do that. And I do accept that it does take time, because the first few trades you put on ever, you are watching them like a hawk. I mean, you are just absolutely focused in on what that price is doing and going through a range of emotions. And I look back at that now and think how silly that is, but of course that's obvious. That's what you think traders do. So anyway, enough on the 7-step process. As I mentioned, I think I'm not designed here to teach people technical analysis or strategies per se. It's to try to help you to put the pieces together and provide you some structure and framework. I'm sure Jeff will mention this anyway, but my trade launch systems introduced earlier this year. Very, very proud to have brought these. There's obviously many, many years of me putting things together in my own MetaStock, and MetaStock said, well, let's just put it in an add-on. So 2 primary systems there, altitude, a little bit more medium term, and ignition more shorter term, and of course a number of different accompanying indicators and what have you supporting all that as well. All right, well, I'm going to hang around, depending on what Jeff would like to do, I'm going to hang around and respond to any questions as they come through, or if Jeff has anything more that he would like to talk to me about. Hopefully he's listening in and he's ready to jump in on top of me.
I'm
thank
right
you for the kind words coming through as well.
Great job,
Jeff.
Stuart. Let's see, any last questions for Stuart? We'll go ahead and let you. We are running a little bit over, but that's okay because you're the last guy. So we saved the best for last, maybe. I'm not gonna.
My apologies.
I'm not gonna really say that because But I don't see a lot of questions. I think it was very, very straightforward and kind of great. So we are going to kind of switch presentations here really quick. I'm going to just make myself the presenter. We do have a lot of great job. Thank you very much Thank you very much. And before I kind of talk a little bit more about what Trade Launch Systems is, and then we're going to do a QA, which you're welcome to stay if you have questions about MetaStock, or I'm going to do a little bit of a workflow that's going to take 10 minutes or less to show you how to run scans in MetaStock as part of the Q&A. But I have a quick question for everybody. How many people have been here the full 8.5 hours? Just go ahead and type it in the chat box if you have. Me. I was just curious. We're getting a lot of I have, so I'm going to have to go count these later on. Somebody's like, I have nothing better to do. Well, I hope that's a statement of how good this was compared to other things you could be doing. So I'll have to go and count those. We are getting a lot of people that have been here all day. Attendance this time around was awesome. Registrations was awesome. These things just keep getting better. So really appreciate the support. You know, we pull in a great caliber of people. And really, we wouldn't be able to do that without you coming and being interested in, you know, it's one of those things that grow on itself. So let's talk a little bit about the trade launch systems. We did earlier this year release it's been a long day, Stuart systems into MetaStock, and it's the trade launch systems is what we called it. It's the altitude trading system and the ignition system, and then the reversal signals as well. Those are the scans that are available for this particular scan. Has quite a number of different indicators that are available for it, a lot of them actually. And to tell you a little bit more about the markets, the systems, my slides got a little bit not out of order necessarily, I just got a little further in them than I thought I was, which is why I'm acting a little bit confused. But the altitude system's a little bit more of a medium-term system. It lasts, trades last from weeks to months, and it uses those wide stops that Stuart was showing before. The ignition system is shorter term. It goes from days to weeks and uses tighter stops in that particular methodology. The one thing I like about Stuart is he's so thorough. And one of his experts is very, very unique in the way that it'll actually tell you, based on how much capital you've got and your risk tolerances, it'll tell you exactly how many shares of a specific instrument you should be buying based on his system. So one of the other things that's pretty unique, it's got a market sentiment indicator that's designed to tell you if the market's bullish or bearish or neutral. So in any case, $3.99 is the cost of that. Again, it's a one-time cost. It's $2.99 or lower with the summit pricing. For those of you that don't have MetaStock yet, well, hopefully we can definitely rectify that, and you'll get a free copy of MetaStock on a trial basis to evaluate these different add-ons. The phone number to call is 800-882-3040. You can chat online, and you can email as well. The phones are kind of, well, they're probably lighting up again. But in any case, here's a recap of all the add-ons that we talked about today. There are Steve Bigelow's, Chuck Hughes, Prime Trade Select, Barry Burns, Top Dog Trader, Stuart McPhee's Trade Launcher, and Vince Vora is our favorite trade. And so the offers are, again, save $100 on one. If you buy two of them, you can save $125 on each of them. And if you buy three or more, we'll give you $150 off. Again, that includes your access to MetaStock RT and MetaStock DC, and it includes the training to help you get started. It is a ridiculously big tool. There's a lot of things that you can do in it. It's like any toolbox. You know, if you know how to run the scans, I'm going to actually spend 10 minutes here in a few minutes just showing you how simple it is. But the better you understand how to use it, the better it's going to work for you. Remember, we've been working on this thing for 30 years, and there's a reason it's been rated #1 for the last 25 years in a row. So again, the phone number is 800-882-3040, and you can chat online with them at metastock.com/sales chat. I'm interested to see what kind of questions you've got.